SIP versus SIP plus STP. Combining SIP with STP for optimal returns. Hello everyone, welcome back to the channel. Today we're going to talk about a popular investment strategy, SIP versus SIP plus STP, and how combining these two might help you achieve optimal returns. So let's dive right in. What is SIP? Let's start with SIP or Systematic Investment Plan. SIP is a method of investing a fixed amount regularly in mutual funds, often monthly. This method allows investors to average out the purchase price, making it less susceptible to market fluctuations. It's one of the most popular investment strategies for long-term goals like retirement because it helps build wealth over time with the power of compounding. SIP offers a few key benefits. Rupee cost averaging. Investing a fixed amount reduces the amount of market volatility. Discipline. It encourages regular investing. Compounding. Over time, the reinvested earnings can lead to significant growth. However, while SIPs can be suitable for long-term goals, some investors may prefer to manage risk or improve their returns using additional strategies. What is SIP plus STP? Now, let's talk about SIP plus STP, where STP stands for Systematic Transfer Plan. STP is a strategy where you first invest in a relatively stable mutual fund scheme such as liquid or debt fund and then systematically transfer a fixed amount from that fund to an equity fund. For example, you might start with an SIP in a debt fund for a few months or years and then gradually transfer the money into an equity fund using STP as the market stabilizes or as your risk tolerance increases. This combination of SIP plus STP provides two key benefits. Stability with growth potential. You first park your money in a low-risk asset and when you're ready, you move it to higher risk, potentially higher return equity funds. Flexibility and control. You can control when and how much you want to transfer, giving you the flexibility to adjust according to market conditions. SIP versus SIP plus STP. Key differences. So how do SIP and SIP plus STP compare? Risk. An SIP directly in equity funds exposes you to market volatility from the get-go. With SIP plus STP, the initial investment is in stable instruments, reducing short-term risk. When you transfer to equity, you do it gradually. Returns. SIPs can give you relatively better returns if the market performs well, but it can also lead to losses during market downturns. SIP plus STP may have slightly lower returns initially because of the relatively stable starting point, but it can help you avoid large market swings. Market timing. With SIP, you're essentially investing without worrying too much about market timing. In SIP plus STP, you have a slightly better advantage of reducing risk by transferring funds in a phased manner, especially during volatile periods. So, which option is suitable for you? Well, if you have a high risk tolerance and are ready for long-term equity exposure, SIP could be your go-to strategy. But if you're someone who prefers a cautious approach where you want to start conservatively and gradually increase your exposure to equities, SIP plus STP might be a better option. It is important to evaluate your risk appetite, investment horizon, and financial goals before choosing between SIP or SIP plus STP. Consulting with a financial advisor can also help you make an informed decision based on your unique situation. Thank you for watching and see you in the next one. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.